All right, so you make too much money to contribute to your Roth IRA account. What are you going to do? Do you have to settle for just putting money into the market and having to pay taxes on all of your gains and dividends? Or are you stuck with just putting money into your employer sponsored plan in a pre-tax way? Well, the truth is there are actually 4 different ways that you can continue to save and put money into Roth accounts even though you're over the income limits. If this is your first time to this channel, make sure you hit that subscribe button down below so you don't miss any future updates like this one. Alright, so now what are the limits before you start losing the ability to put money into a Roth? Well, if you're a single filer, you start losing the ability to put money into the Roth once you start crossing over the $125,000 income limit. Now these are adjusted limits on your taxes. So once you go to 125, the amount you can put in starts decreasing. Once you hit 140, you can no longer use the Roth at all. If you're married, filing jointly, the phase out starts at 198,000, and by the time you guys hit 208, then you lose the ability to put money into the Roth IRA. Now, the first way you can get around this is by doing something called a Roth Conversion. Now, what a Roth Conversion is simply taking money that you have already invested in, say, like a pre-tax retirement account, and what you're going to do is move the money into a Roth IRA. Now, these conversions don't have income limits to them, and they don't have any kind of contribution limitations. So it doesn't matter how much money you want to move and put into the Roth IRA. Just know that whatever you move does have to be taxed. So you gotta make sure you have the money available to pay that tax bill. So for example, if you have, say, $50,000 sitting in an IRA somewhere and you want to move that into a Roth, you could actually move the entire $50,000 in one shot. All you have to do is foot the tax bill, and then you have a Roth IRA with the difference or what's left over after taxes in there, and that money can be growing in your Roth tax-free for the rest of your life. Now, because you do have to pay taxes on this, you want to make sure you're looking at your current taxable situation so you don't jump up 1 or 2 brackets by mistake by moving too much money. So this is something you should work on with a CPA or maybe even a financial advisor so they can help you pinpoint and calculate your taxable income and you know exactly how much to convert so you don't get stuck with an unnecessarily high tax bill. Now, the second way you can put money into a Roth IRA is doing something called a backdoor Roth IRA. Now, this method is kind of like the first one, but what you're going to do is put money into a non-deductible IRA. So you're putting money into an IRA with no tax benefits. There's no pre-tax deduction and it's not a Roth. It's basically pretty much like a taxable account. You pay taxes on all of it, but it's still within the IRA shell. Now, the reason we do this is because of that same IRA conversion rule. So by putting money into a non-deductible IRA, because it's now an IRA, you can do the same conversion. I can move money from a non-deductible IRA into a Roth IRA. Now, the tax bill you're gonna have to pay is just gonna be the interest that you earned in the time that you put the money into the non-deductible IRA before you convert it into a Roth. So theoretically, if you put, let's say, $10,000 into a non-deductible IRA today, and tomorrow you went ahead and converted it into a Roth, there would be very little of any gain there, so your tax bill would be pretty much nothing, and you'd have money going to the Roth in that manner. One word of caution though, that this rule is kind of a tax loophole in the sense, and it's currently just became legal in 2010. This could change in the future. Now, the IRS will be looking at these transactions, so typically speaking, when I consult other tax professionals, is they advise waiting at least 1 year before you do the conversion. So in other words, if I put an amount of money into a non-deductible IRA today, I should wait at least 1 year from now before converting it into a Roth. Now, you don't have to do it, but it's just going to keep you out of the IRS crosshairs in case you're going to get audited. And again, there is no contribution or income limits to do this strategy at all. So the third way to get money into a Roth account is by using one that's sponsored by your employer. So many employers actually do have a Roth 401k or Roth 403b option available. So it's something you want to talk to them about and see if that's there. If it is, your employer-sponsored plans, even if they are Roth, have no income limitations to them. You still are subject to the contribution limits that are the same, which for 2020 is $19,500 for those under age 50 and up to $26,000 for those over 50. So you can put up to 3 times more into these accounts than you could into a normal Roth IRA account, and there are no income limits. It doesn't matter what you make. So that's something you should definitely check with your employer about and max out if you're wanting to put some money into a Roth and you're making too much money to do that. Now, the fourth and final way to get money growing for you in a tax-free manner is by utilizing supercharged life insurance. And what that is basically life insurance designed as an asset class to maximize the cash value growth. Now, these policies are designed in a way to minimize costs. So essentially what you're doing here is buying a life insurance policy. You want to make the death benefit as low as possible to keep costs down, and you want to put the most amount of money into it, therefore maximizing your cash value growth. Now, most people don't know that these life insurance policies have been around for much longer than the Roth IRA has, and it has pretty much all the same benefits. All the money that goes into the policy is done after tax, and it can be taken out pretty much at any time you want to, tax-free. The unique thing with these life policies is there is no age requirement to access your own funds. So you don't have to wait to 59 and a half like you do in a Roth IRA. You can get your money out anytime you want to. On top of this, depending on the policy you set up, you can have your funds growing for you on a guaranteed basis, where you're getting a set rate of return, like 4 or 5% every single year. That way you can have steady returns over the long run. Or you can choose to have your money participating in the stock market, so you are able to participate in the gains of the stock market. And yes, it is possible to get double-digit returns in these type of life insurance accounts, but you're also protected from the market losses. In other words, you don't participate in any of the down years. So your worst case is a 0 year. You don't lose any money due to market volatility or downfalls. The other nice thing here is because it is life insurance, you do have that death benefit, and legally it has to be more than what you put in the account. So if worst comes to worst and you were to pass away before you reach your retirement, there'd still be a tax-free payout to your beneficiaries. And the other cool thing with these life insurance policies, many of them today will actually use the death benefit before you pass away in what they call living benefits to cover the cost of any kind of long-term care needs. Now, these aren't long-term care policies itself, but the way they're written, they act just like them. That if you need some kind of care, they basically give you a portion of the death benefit to use today to enjoy and cover your bills. So these things are kind of like Swiss Army knives, and that they can do many different things. The key here is finding someone competent enough that understands how to design one properly, so you can go about using it and reaping all the benefits. So if you want to learn more about that strategy and how it can benefit you, then go ahead in the description below and download a link to my free report that's called Invest in Yourself, a safe and secure way to grow your wealth and avoid Wall Street, the banks, and the IRS. I hope you guys found this information helpful. Make sure to give it a thumbs up and drop a comment down below with your thoughts, and I hope to see you guys soon. Remember that your future depends on what you do today.